The HOOY ETF from YieldMax is printing money. Its latest dividend was nearly $7. The one before that, over $6.50. Let's get to the bottom of why this is happening. Is it sustainable? And for those who don't have shares, is it too late to get in? This video is not financial advice, nor is it a recommendation. Please do your own due diligence before investing into anything. It's no secret, HOOY has been doing very well since inception. It's been paying out some crazy high dividends, and the share price continues to go up in spite of those dividends. Normally with YieldMax ETFs, especially the single stock covered call ETFs, you usually either get high dividends or good share price appreciation, rarely ever both. So let's take a peek under the hood and see why this is happening. In all YieldMax single stock ETFs, they rely heavily on the performance of the underlying asset. In this case, it will be Robinhood stock. And it just so happens that Robinhood, the underlying stock for this ETF, has been on a tear since just before HOOY's inception. And that rising tide lifts every ETF that trades options against Robinhood in the same direction. HOOW, Round Hill's equivalent of HOOY, happens to also have benefited as well. Its inception date was a bit later, so it's seen less of that upward momentum. Another factor working in HOOY's favor is the addition of the call spread strategy to all the single stock YieldMax ETFs. The ability to go from a covered call strategy to a call spread allows them to participate in more of the gains, especially on big individual days. Now that we understand why this is happening, we need to ask, is this sustainable? Usually when an ETF pays nearly $7 in a single month just in dividends, that usually is a very high risk of NAV erosion. But it looks like the underlying stock, Robinhood, is doing so well in spite of that the price continues to climb on HOOY. Some of that risk, I believe, has been blunted by the fact that they use the call spread strategy to participate in more of the gains, so that even if it goes up very sharply, they can capture more of those gains, which can help them recover what they pay out in dividends. However, as with any of these ETFs, it still relies on the momentum of the underlying stock continuing in this direction. So as long as Robinhood continues this moonshot, things will still be great for HOOY. But once it loses steam, we are going to see the dividends and probably the share price appreciation leveling off. If it goes down in value, HOOY is going to suffer. So the last question, is it too late to get in if you don't have shares, or to add shares if you already have some? As we can see on both the daily charts from both Robinhood and from HOOY, there is what looks to be a double top, which means momentum has slowed down. This could be a play either to buy shares of HOOY, knowing that the implied volatility of Robinhood goes up when momentum goes down. However, you might also decide instead to just sell puts against either Robinhood or HOOY yourself. But what do you think? Is it better to buy shares of HOOY, to sell puts against HOOY and or Robinhood, or to sit back and see what happens? If you like this video, you might also enjoy this one here on the screen. Subscribe to join the Cash Flow Club and hit the bell for notifications so you don't miss a single video.